Hi everyone, my name is Carolyn Boyd, and as a litigation attorney with actual class action experience, I thought I would provide an update on what is unfolding with the litigation surrounding Robinhood and the GameStop stock, among other stocks. Now, I should note that I am not involved in any of the Robinhood litigation, nor am I seeking to be involved in it, and I'm also not providing any legal, financial, or tax advice. I'm simply here to share an update on what I've learned, and my passion for this channel is to help provide information and help empower individuals to take charge of their financial life and succeed in all of their financial endeavors, whether that's financial freedom or just having more financial stability, whatever that is. My hope is that if I share what I've learned, it will help empower you to fast track those goals. Okay, so a quick update. As you may have heard, yesterday, January 28th, 2021, Robinhood halted the ability of investors to buy certain shares. The one that is getting the most notoriety is GameStop, and it was essentially, and it wasn't just Robinhood, there were other brokers who did this, but Robinhood is the one that is the primary focal point of this. Yesterday, and in the days prior, the stock had been rising dramatically, and then after these halts were put in place, the stock dropped precipitously, over 40%. And so, as a result, there have been a number of lawsuits that have been filed yesterday and today as well. And this is one thing that I really wanted to point out, because I have seen in the news, a lawsuit has been filed, a class action lawsuit has been filed. But in fact, there have been multiple class action lawsuits filed. There have been lawsuits filed in New York. That's the one that's getting the most notice. However, there have been multiple class action lawsuits filed in California. There have been class action lawsuits filed in New Jersey, in Florida, in Connecticut, in Pennsylvania, in Illinois. And these are just the class actions that I've seen, but there are also individual lawsuits as well. There does appear to be a common thread with these class action lawsuits. Primarily, they are raising causes of action such as breach of contract, breach of implied covenant of good faith and fair dealing, which is essentially a provision that is implied, whether or not it's stated, in every contract. And they're also raising negligence claims, claims of, I did see one claim of fraud, that one is not as common. Breach of fiduciary duty is also a very big one. Also in California, there have been causes of action based on California statutes, such as the California Consumer Legal Remedies Act and the California Unfair Competition Law, which protects against unlawful, unfair, and fraudulent business practices. I should also note that the New York Attorney General has opened an investigation into this, and the U.S. House Committee on Financial Services has also announced a hearing on this as well. So in terms of my observations for the case, and again, this is not legal advice, this is just my personal opinion and observation, having just a preliminary review. Things are unfolding very quickly, but the first requirement that these cases are going to have to meet is to show that they are the appropriate type of case to be certified as a class, and the requirements for that are found in Federal Rule of Civil Procedure Rule 23, and there's a few different requirements that they have to make to show that it is suitable to proceed as a class. If they can get past that part, they're going to then get into some of the other individual causes of action. And again, my just brief observations on some of these causes. For the breach of contract cause of action, we can anticipate that Robinhood is going to say that they had a right under their terms of service agreement with the investors to terminate trading services. Whether or not this is going to succeed remains to be seen. There are some arguments on the other side, including, for example, as one point, that this is where something like the breach of the covenant of good faith and fair dealing might come in, because you're supposed to act in good faith. And here there is potentially an argument that they weren't acting in good faith, because it was not a unilateral halting of trading. It was only with respect to specific stocks, and within that, only with respect to a specific direction. It only allowed for people to sell the stock, but it did not allow people to buy the stock. So they exercised a certain level of discretion in terms of how they allowed the investor to proceed that had an influence on the stock price, and so that may not qualify within the breach of contract claim. Another issue is that FINRA, the Financial Industry Regulation Authority, does have a Rule 5310 that does require brokers to execute trades, within certain rules, and so that provision, or the application of that provision to say, well, we can decide how or when you can sell a stock or what direction, may run afoul of that. Again, these are just issues to think about and see how the court handles them. For the negligence claim, that also may potentially, among other things, rest on this FINRA Rule 5310, in the sense that for a negligence cause of action, one of the essential elements that you have to show is that the defendant had a duty. So the issue becomes, did Robinhood have a duty to execute on these trades? And so one potentially could argue that under FINRA Rule 5310, they did have this obligation to execute on these trades. And so we'll see how that plays out. And one of the more common causes of action that I've seen across these complaints is the breach of fiduciary duty. So for the fiduciary duty cause of action, a fiduciary duty is essentially a heightened obligation. There are different kinds of relationships. For example, a contractual relationship is considered more arm's length. The parties are kind of on equal footing or close to equal footing. With a fiduciary relationship, it's considered a bit uneven, and because of that, one party has certain duties that it owes to the other party. And there are several different fiduciary duties, but two of the more common ones are a duty of care and a duty of loyalty. For the duty of care, I can see an issue with this case because, the issue will be essentially, did Robinhood owe a fiduciary duty to execute on the shares? Beyond its contractual duty, did it owe a fiduciary duty? And again, we have that FINRA rule that comes into play potentially, and so I can see that becoming an issue for the courts to look at. And then on the duty of loyalty side, now these fiduciary duties, the point is that because of the unequal footing, the one party who owes the duties has to act in the best interests of the other party. And so the one party owing the duties has to put the other party's interest above its own. And another issue that comes up a lot is, was there a conflict of interest? Here again, I do see the potential for an issue because and I don't want to get too far into this, and maybe I'll make a separate video as a background, but one of what basically happened is that a number of hedge funds had a large volume of short positions in GameStop and a number of other different stocks, but we'll just focus on GameStop here. There are a lot of short positions, like more than what there were of even outstanding stocks. And so a number of individual retail investors realized this and created what's called a short squeeze, where basically a short position is where you are betting that the stock market's going to go down. We all know that one way to make money in the stock market is to buy a stock at a low price and then sell it at a high price. But there are other ways to make money, and a lot of the sort of more professional big hedge fund companies use some of these other tools, such as options. And a short position is where you're where you're betting that the stock is going to go down in price. However, if instead of the price going down, it goes up, then the people holding the short position then have to scramble to buy the stock to cover their short position and close it out. And so that forces the stock price even higher. So then it becomes a race of these firms trying to cut their losses or minimize their losses. But because of what happened with the stock rising at such a rapid rate, there were a lot of losses sustained by some of these hedge funds. And one of them was Melvin Capital. it was so bad. I mean, we're talking billions of dollars in losses. It lost so much money because of this short squeeze that what ended up happening is they had to get emergency funding, which they got from a company called Citadel. And here's where Robinhood may potentially run into big problems, because Robinhood has a relationship with Citadel. So if it is seen that Robinhood was basically taking a position that favored Citadel over its own investors, and if it's shown that there is a fiduciary duty there, potentially you can make an argument that this fiduciary duty was breached because there was a conflict of interest with Robinhood having this outside relationship with Citadel and acting in a way that favored Citadel over the individual investors, because once Robinhood cut off the ability to continue buying the shares, the stock price dropped by a large margin, over 40%. So potentially there is a big conflict of interest issue that I can see coming up there. Another issue I see is that one of the arguments that's either anticipated or has already been made by Robinhood is that they were trying to protect their solvency, because a lot of these people were trying to make these issues using margin or essentially loaned money that they received from Robinhood. The problem I see with that argument, and again, this is my own personal opinion, but the problem I see with that argument is that Robinhood did not limit the prohibition to people who were buying on margin. It also prohibited people who had cash positions, who were trying to buy with their cash from buying the stock. So I do see that as being a potential problem with that argument. Another argument that I see being talked about is whether Robinhood was trying to act in the best interests of the investors by trying to prevent them from investing in what essentially is a bubble. I mean, the stock, had departed from its fundamentals. It was just kind of rising, an incredibly fast rate. And so I can see on the one side the argument being, well, we were trying to protect these individual investors from suffering a major loss when the stock crashed. However, again, I do see a problem with this, because in the end, when you have people who have already bought and they're seeking to buy more, and that stock was going up, and then they only allowed the stock to go down, this would have resulted in a lot of people losing money because the share price dropped so significantly. And it also presents a danger, in my, again, personal opinion. I do think it's dangerous to have these major brokers basically saying, we're going to pick which stocks you can buy or sell, and we're going to determine whether or not you can buy or sell them. In other words, we get to determine which direction you get to engage in that transaction. I do think there is a danger there, and so just from a public policy perspective, I can see some courts maybe taking issue with this as well. And also, at the end of the day, if you look at the background on this, what essentially happened was a bunch of individual investors realized that the hedge funds were taking a major short position, and essentially is a fairly sophisticated execution where they essentially beat the hedge funds at their own game, or were beating them at their own game. So to take the position that Robinhood was trying to act in their best interest to protect them is, well, I can see there being some problems with that, because again, where do you draw the line? And that really, personally, I believe, should be in the hands of the individual investor, should get to say how they're going to execute their transactions. And so I do see a public policy problem with that. So in terms of what happens next, well, we've already seen it play out in the stock market, and we are seeing it play out in the courts now, and we can expect to also see it play out in legislation. We can definitely expect to see some legislation come out of this, and also some government involvement in terms of government investigations, which again we're already starting to see with the New York Attorney General opening up an investigation, and the House looking into hearings on the matter. So we can expect to see more. I hope you found this video helpful, and if you did, please give it a thumbs up. Also, if you would like me to continue to update you on the status of these cases as they progress, please also give it a thumbs up or leave a comment below, and I will do my best to keep you posted, sharing whatever information I find. I hope you are all doing well, and I look forward to seeing you in the next video. Thanks. Bye-bye.